stock market's flirting with record highs. That's good because you're making money, but it's bad because it means you have to worry about just how high those prices are.
One of my concerns is just simply valuation. Like, you have to either expect higher earnings growth, like significantly higher, or you have to assume that multiples can be higher. And maybe that's true because maybe the Fed gets to cut more, but hopefully not too much, because if they're going to cut a lot more, then it's probably because the economy is significantly slowing down, like the labor market is significantly slowing down. And then you probably don't have the earnings growth. So things are fully discounted to me in the US, I should say, at the S&P level.
That's Stephanie Guild, Chief Investment Officer at Robinhood. She's in for the big interview today, and she will talk about what she's seen investors doing and how they're changing the way they are approaching what she considers to be a stock picker's market. And she'll also talk about long-term how market conditions have changed. But up first, Chip Lupo, writer and analyst for Wallet Hub, discusses their 2025 household debt survey. And more than 40% of the respondents think their household debt will increase in the next 12 months. Plus, Mike Dixon, head of research and quantitative strategies at Horizon Investments, plugs his system in to the Money Life market call. Let's ride. This is Money Life for November the 12th. Thank you so much for joining me. We have a great show planned. And we've been doing this for a long time, more than 13 years. We've done thousands and thousands of shows, and yet we're always still bringing on new guests and folks we haven't talked to before. And sometimes we have guests on where we're like, did we talk to them before? I think I introduced Stuart Katz from Robertson Stevens as making his debut earlier this week. He'd actually been on the show one time previously, something like 9 years ago. But today, for sure, Steph Guild from Robinhood makes her debut on the show. Mike Dixon, head of research and quantitative strategies at Horizon Investments. He is also making his debut. I think you're going to like it. I hope that's what we can bring you, is exposure to folks that you want to hear from, that you've heard from in the past, and then exposure from folks where you've never heard of them, but maybe you are benefiting from getting a chance to hear from them. Right now, what the markets seem to be focused on is corporate earnings, because that's where the growth is coming from, and then the end, potentially, of the government shutdown. But the hope is that the market will react to this stuff positively, and you are getting plenty of forecasts on this show that suggest that it's not necessarily smooth sailing to the end of the year, but that the troubles that you can foresee aren't coming home to roost yet. And frankly, that means you have to decide how long are you going to ride before you try to maybe fix things or change things, because you don't want to miss out, but you also don't want to get burned. A lot of investment strategies are working right now, and the problem is they will work right up until the moment when they don't. Kind of feels like my car, which is in the shop right now. I drive an old beater of a car. It's all I need, and it's perfect for me right up until the moment where it isn't. And the question is, have I stuck with it for too long? Is it time to make a change? And what will be best for my money? And that's a question that I've got to ask about my car, but it's also a question that people have to ask about their portfolios. And you should treat it that way. You should not be thinking about your purchases or your sells in the stock market being dramatically different than your purchases and sells anyplace else. You want a methodology that makes sense. When you go to the grocery store, you are not looking, going, let me buy something before it's ready. It's not ripe. I cannot use it for a foreseeable time. You're trying to go, let me get this because I think it will be perfect in a few days if it's something you're waiting for, or it's great right now, or it's exactly the flavor that I need, or whatever it might be. And oh, by the way, maybe it's on sale. That kind of stuff, that also plays out in the market. I'm Chuck Jaffe, financial journalist, your host here. Money Life is independent financial talk. We talk to everybody. And I think we probably have, or we will eventually talk to everybody. That's part of it, but that also gives you a lot of perspectives, and we hope you like it. If you want more of my take, don't be shy about writing me, chuck@moneylifeshow.com. Right now, you don't have to do anything other than sit back and relax as we bring you Chip Lupo, Steph Guild, and Mike Dixon. We'll be talking about Wallet Hub's household debt survey when we really start talking right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Now let's take a look at what the survey said. Welcome to The Survey Said on Money Life, where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And we're looking at the 2025 Household Debt Survey from WalletHub. You can check out WalletHub at wallethub.com, where they have a lot of information that will make you a better, smarter financial consumer. Today, we are talking about when people are doing with their money. Well, what they're doing is they're blaming their rising debt levels on high inflation. And maybe that's what they should be doing, but there's a lot more that goes into it than just inflation. And there's a lot in this study. Here to talk about it all, Chip Lupo. He is writer and analyst at WalletHub. If you find where we mentioned him in today's show notes, or you find him on the guest page at moneylifeshow.com, you will find a link that gets you directly to the details on the household debt survey for 2025 from WalletHub. Chip Lupo, welcome back to Money Life.
Hey, Chuck. Thanks for having me. Appreciate it.
6 in 10 Americans are basically blaming high inflation for their rising debt levels. They're not looking in the mirror and going, I spend more.
I'm glad you brought that up, Chuck, because this is a staggering number. It's one that I can't get past. 3 in 5, 60% of Americans. And I think we're at the point now where consumers are beginning to blame inflation as opposed to citing inflation as a reason for these rising debt levels. Now, granted, prices of goods are still high, homes are high, cars are high, but inflation is not rising anywhere near at the pace that it was 5 or 6 years ago. I think more and more people are using this as sort of maybe an excuse or maybe a rationale to explain the rising debt levels, when it could be that A, you're spending more, and B, you're not paying off enough on your debts to bring those balances down.
As I looked through the survey details, there's a lot of things in here that certainly add up to people struggling. And I don't want to minimize struggles, because the struggle is and should be real for a lot of us. You know, we're not independently wealthy. We've got to use credit cards or what have you to make sure that we can make ends meet, but we don't have to necessarily spend in excess. And I don't see anything, and maybe that's because you're not asking the questions, but I also don't see it as a general rule in any surveys of folks that says, like, I feel like I'm drowning in debt. And oh, by the way, I've dramatically curtailed my spending and I'm still struggling.
Exactly. And there's a stat here that says 56% of Americans say their household is struggling with debt. Again, now, are you struggling because you're working on getting those balances down and there's not enough money coming in to cover your daily expenses? Or are you adding to that debt by spending more?
Yeah, your consumption habits have a lot to do with your debt outlook, whether you want to do it or not.
Exactly. And again, Chuck, we've spoken on this many, many times. But we have the stat here with the credit cards. More than 1 in 3 people feel like credit card companies own them. Now, credit cards are a large component in this debt. And again, it comes down to people not knowing what their interest rates are, not knowing the consequences of just paying the minimum balance every month. So that's a start. People need to take stock in exactly the terms of their credit cards are, what their spending habits are, review your credit card statements, eliminate some of these unnecessary expenses, and then work on paying well above the minimum, get those balances down.
It's funny that you bring this up. I recently was talking with one of my stepdaughters. I found out that she had credit card debt, which I was surprised by, because she doesn't spend a lot of money, but also she makes a decent salary. And she's like, no, I could afford to pay it off, but I want to be able to have whatever. And I'm like, your credit score is not good enough. You should be paying it off. Like, there are all these reasons, obviously, to pay it off. I don't have to tell you the benefits of paying it off. But I was surprised, because she just turned 27 on the day that you and I are recording this, that she didn't know better, that she'd gotten to 27 without knowing. And as she had sort of pointed out, she's like, no, nobody ever talked to me about this. Nobody ever did anything. And she didn't realize that she was not exhibiting good behavior. I know we can't quantify it, but when you are studying people and they're saying, I'm owned by my credit card company, is there a way to say you're owned by your credit card company because you willfully take on bad habits? And that's not you're going out and spending. That's you could afford to pay more than the minimum, but you don't.
Right. And you check off a box when you apply. It says you agree to the terms of this credit card agreement. So you're bound by that. Now, fortunately for your stepdaughter at 27, there's still plenty of time to right that ship and get that credit score back up. And for folks who are maybe twice that age or older, the window closes pretty dramatically. So there's still time to remedy that.
I would say, actually, that even for the people who were twice that age, and by the way, my stepdaughter cleaned it up pretty much immediately because she did have the money to pay it off. It's that other side that says, if you can take care of it, a year of paying it down, doing all the right things, paying more than you can, if you can eliminate the debt, doing whatever, will get you to where your credit score is good and you're in better shape pretty quickly. It may not make it that you're not worrying, but that may be more about you having worries than it is about just exactly how bad the debt is once you've taken care of it.
Exactly. Yeah.
One of the things that I thought was interesting is that more than 80% of the people you guys polled on this think it's important for people to track their net worth. I find it highly unusual that people do track or know their net worth. Where did that come from?
Yeah, that's a staggering number now, because I think that, people are, you see a lot of these, what they call high net worth individuals who have, whether it's 9 figures or billions of dollars worth of assets, while they might not necessarily have so much money in the bank, but their worth is so much more. So I think a lot more people are taking stock into that. And there are tools out there now, maybe more so than where a generation ago, where it's easier to do that. And I think, sadly, though, I think some people are probably going to be disappointed when they go out there and find that they have little or no net worth.
Yeah. I mean, I think the other way could be that some folks would recognize, wait, hold it. I am the definition of house poor. Maybe I'm a little bit better off than I think I am. Maybe I don't need to worry as much.
Right. But it's also a good time to take a look at, if you have investments, to take a look at those and maybe look at where you are in your life. And maybe if you have a 401k or an IRA, look at maybe readjusting that depending on your timeline, rebalancing some in particular sectors, or looking at just different types of investments, whether it's stocks or bonds, and kind of level that off and minimize or increase your risk, again, depending on what your timeline is.
It's never a bad time to control your debt and know what you're doing with it. Chip, great stuff as always. I'm sure we'll talk again soon. Thanks for joining me.
Yeah, looking forward to it, Chuck. Thank you.
That's Chip Lupo, writer and analyst at Wallet Hub. Go to wallethub.com, not just to find out about the household debt survey we've been discussing, but to make yourself a better consumer around credit cards and all of those other sorts of things, to learn the things that you need to know to do this. And if you want to learn more about money life in general and living the money life, stick around. We'll be right back with more right after this message.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Welcome to the big interview on the November 12th edition of Money Life. Joining me now, Stephanie Guild. She is Chief Investment Officer at Robinhood. And yeah, it's Robinhood.com if you want to learn more, if you want to check out the things that they do for you as an investor, if you could become one of their clients. But also, they don't just act as a platform. They are looking at markets as well. So we're going to go in a lot of different directions. Let's jump into it. Steph Guild, welcome to Money Life.
Thank you. Thanks for having me.
You're in, as I look at it from the outside, something of a unique place in terms of you're overseeing investments as a money manager, but you also get to see what people are doing with their money, how investors are behaving. So I want to cover both of those things here, but I want to start with your base expectations for the market for the remainder of 2025 and as you start to formulate your outlook for 26.
Yeah. Looking ahead to, well, at least for the end of the year, if you can say that the next 2 years are accurate in terms of consensus earnings growth expectations, which consensus says that it's going to be around 13% a year for the next 2 years, and you apply a multiple of, let's say, 20 or 21 times, you can get to, 6,900 to 7,000 this year end, which is about, we're at 6,900 about now. So, I see that as a possibility, especially with the shutdown ending now, that, it feels like we could continue to grow. For next year, I think one of my concerns, and I haven't actually come up with what my expectations are for next year yet, but one of my concerns is just simply valuation. Like, if you have to really start to apply, you have to either expect higher earnings growth than what I just mentioned, right? Like significantly higher, or you have to assume that multiples can be higher. And maybe that's true because maybe the Fed gets to cut more, but hopefully not too much, because if they're going to cut a lot more, then it's probably because the economy is significantly slowing down, like the labor market is significantly slowing down. And then you probably don't have the earnings growth. So I'm just a little bit like things are fully discounted to me in the US, I should say, at the S&P level.
There are basically three legs to the stool that have been driving the market in recent years. One has been Fed rate cuts. They basically stopped for a while. That's why we've had to rely on earnings, that being the second one. Now we're hoping that rate cuts may help. But the third has been the investor. And the investor has been buying every downturn as if it's a dip and an opportunity. But the more I hear from investors now, the more I look at sentiment surveys and the rest, the more nervous they are. Is investor behavior, as you guys watch it and see it at Robinhood, starting to change at all? Is there a little less activity on the dips, or is there more activity on the dips because, hey, those valuations are so high, put anything on sale and I'm ready to buy it?
We've definitely seen our customers continue to be net buyers, particularly since Liberation Day happened. So, and the way in which they were dip buying has shifted over the course of the year, in that during, like, when Liberation Day happened, they started stepping in, especially on the day of the pause. But they did it through broad-based ETFs, much more than they had prior to that or since. And then since that time, they really have just been playing individual stocks. And the dip buying hasn't necessarily been broad-based. In fact, what we see is that they own a core allocation to a certain set of companies that, sort of represent the things that they see and use in their life. And then they trade around that. So the dip buying ends up being on a single name basis. And for example, over the last week, we had NVIDIA and Tesla being things that were net buys, especially, last week or so, there was, kind of a pullback, but Amazon had good earnings. Apple had, a decent reaction to their earnings the previous week. So you saw those as being a place of a source of funds, or a place they were trimming. So it's really been on a single name basis. And I understand the caution of, this whole like dip buying kind of activity, but I actually do think we're in a stock pickers market. And I think a paradigm shift started post 2022. And I think we're still in it.
Explain the paradigm shift as you see it happening.
What I see is we had, starting in the early 1980s, we had interest rates dropping pretty consistently over many decades until we got to 2022, right? And then post-COVID, we had inflation and the Fed had to raise interest rates. But, as part of that, the 10-year Treasury yield, which really informs what companies pay on interest, what mortgage rates are, all of that consistently dropped for decades. You also had, for companies, consistently falling corporate tax rates over that same time period. And now we have some of the lowest tax rates in the world. We're kind of in the middle of the world in terms of the corporate tax rate. And then you have interest rates that bottomed out kind of in that 2020 time period and rose. And we're around the 4% mark on the 10-year Treasury yield. Even if we have falling interest rates from here, it's never going to be like the interest rate drop that we saw over those many decades, where interest rates were double digits to now. And in fact, the Fed wrote a paper in 2023 that their analysis showed that 40% of US profits came from a combination of interest expense dropping and tax rates falling. And so I think we're now at a point where those tailwinds, along with other tailwinds that we had over that time period, like globalization, right? And then that meant jobs went overseas, costs went down for companies. I think a lot of that is like fracturing, or at least the tailwinds aren't as strong as they were over those many decades. And as a result of that, I think we're in an environment where company management decisions matter a lot more. I think it's why you've seen higher turnover in CEOs over the last few years. And it means that I think you can differentiate in the stocks that you buy versus the ones that you don't. That's why one of my sayings is always like, there's more to life than the Mag 7. I think you want to treat each individual one as its own, investment rather than buying them across the board. So that's kind of my sort of secular starting point right now. And that's what I see our clients doing, taking advantage of.
There's more to life than the Mag 7, though the market as a whole hasn't seemed to recognize it.
They were if you look actually up until like the last month or two, there was actually not every Mag 7 name, was up. And then just in the last month or so, I think you've seen that kind of turn around, obviously. And that's going to happen, I think, from time to time. But, not all like the different, you see the difference between the way Meta had great earnings, but people are getting nervous about how much they're spending relative to their cash flow. And then you saw a different reaction to other ones. So I still think there's differentiations between them, but yeah, certainly I could be rebutted from the last month behavior.
Well, it brings up something interesting. I was talking with some other guests off air where they were asking who I was going to have on the show, and I mentioned that you were coming on, and I got into an interesting discussion with somebody where one of the things that Robinhood has done is tried very hard to democratize investing, and that's been part of your message. It is something you guys have talked about, and I will point out, and it's important as people hear this, that it's not a criticism. I'm looking for really an insight here. But you talked about how you're finding more investors saying, I'll have a core portfolio and I'll buy some stocks around it, et cetera. I'm curious. I would say that the guy who democratized investing was Jack Bogle. Now, I would say this not only because I was friends with Jack for a long time, but because, if anything, the index fund being able to buy a basket of stocks super cheaply winds up being the thing that made it that everybody could participate in the market. And they could do it in a way that didn't necessarily shoot themselves in the foot because they made a bad judgment. When it comes to Robinhood's style of democratization, how much of it is about you are on equal footing? How much of it is about you have access? Because there is a difference between you've made it that I can participate like the big guys do, and you've made it that I can succeed.
I think access is the first step, and that's what we provided. And we continue to expand access in different markets, stocks, crypto, futures, options, index options, all different kinds of things. I do have lots of opinions about index investing, but I'll put that to one side because I do think that what we try to explain, and we actually do see this behavior too, is that there's a base holding of cash. Like we've had a lot of people using our high yield savings sweep product. Then I often tout, like I say, your next thing should be like a diversified portfolio, whether that comes from ETFs or you just own, a bunch of different stocks that are in different areas of the market. But then I think one thing that it almost makes me mad that the touting diversification can lead, I think, to over diversification. And diversification helps when you already have a lot of money. When you want to level up your wealth, you do need to take some risk. And I think if you can build your portfolio, your set of investments in the right way, which is like you have your sleep at night cash, you've got your diversified assets, and then you have this piece, once you've built the rest, that, does take some educated or risk adjusted or whatever word you want to use, investments that could materially change your overall wealth trajectory. Like, I actually think that's the right approach for the everyday investor. And I'll tell you, like, we have a Hood Summit. We call it Hood Summit. We've done it twice now. It's our sort of annual client conference. And it's just always like brings us back to our why, because there's so many people there that show up and say, I'm going to get to take care of my kid in a way that my parents weren't able to. And it's when you look back, like labor's share of overall profits and income, like it's just never been the same as if you'd been able to participate in the stock market. Now, being able to do it through an index fund or single stocks, I actually think there's room for both. I don't think you'll learn as much just by investing in an index as you would by taking some, positions in individual companies and really learning about them and understanding them.
Oh, I'll agree with that completely because it's much easier to pick an individual stock if you go out and learn about it than it is to pick a fund, which is a basket of stocks that you kind of have to take a big leap of faith on. But it's much easier to buy a fund and get your diversification than it is to buy a portfolio of stocks because you have to have that knowledge then about more than one.
Yeah, I agree.
You talked about the other things that are happening because the access point is also in many cases to things that until recently a lot of investors didn't want to know about or felt too complicated, like some of the options or some of the tools that would be, let me put in trailing stops and things along those lines. I'm curious how much or what percentage of the Robinhood clientele uses those tools. And if you, as an observer, believe that they're using them correctly, because, options have two different sides to them. On the one hand, they're kind of a portfolio insurance, like, hey, let's make sure I'm doing the right things and backstopping or what have you. And on the other hand, they are this tool that can be like, wow, I can really turbocharge things.
Yes.
And in the middle, you can get caught and kind of splinched there and have uncomfortable outcomes. So you provide access to the tools, but I wouldn't want somebody to rent me a nail gun for fear that I blow my toes off and not get things nailed. So the tools that you are providing, how do you see them being used and how much has the audience or the clientele kind of come up to speed to be able to use them right in market conditions that, oh, by the way, might be setting them up for a fall? It's been a lot easier as the market has gone and stayed at record highs for a while than it would be in a market that was seesaw.
Yeah. I'd say, look, we try to provide as much education as possible about how to use options and not just focus on, the pure leverage plays, but try to teach people about like spreads and things like that that are a little less, can help you sort of mitigate the risk in the position that you want to put on. And certainly we've seen growth in the use of different kinds of option strategies over time. I would say in the beginning, it was very much like your basic buy a call, buy a put. And we've seen an expansion of the different kinds of use. In addition to our launch of index options has also helped expand that use. But people talk on social media about their wins and their losses. And, not everybody makes money on the investments that they end up choosing for themselves. So, that's something that we care deeply about. And we want to make sure that we give people the opportunity to understand how to use the different tools in their toolkit. But this is a place that we want people to feel like, they're empowered by their own financial future. So part of that can be you're not going to make money on every single thing you do.
Well, making money or not making money, one of the things that social media picks up on the most are the meme stocks. And you talked about how not everything is the Mag 7, but I would imagine that at Robinhood, you also want to spread the message that not everything is a meme.
No, not. I mean, I think that word gets a bad rap. I think it got created in a weird time in our human history, which was, in COVID when we were all at home and there wasn't a whole lot of other things for any of us to do. And I think to me, it's more about a community. Like I'd liken it a little bit to my own experiences. I spent 21 years at JP Morgan prior to joining Robinhood. And where I learned the most was sitting on a trading desk next to people who were doing a similar job to mine and us talking about different things happening with different companies, with different investments, no matter what it was. And it was a way of community building and learning. And I think that's what quote unquote meme stocks have become, is that like they exchange ideas, they exchange analysis, and then they decide together in a way to be invested in the same thing and talk about it. And I think that to me is pretty cool rather than being something that you can scoff at.
That's a very different form of democratization of the market.
It is.
But again, that might be a difference of democratization or access. Now you have access to those other traders and those other people with their thoughts. And in the old days, you had to be on the trading desk.
You had to be on the trading desk. You couldn't be an everyday person doing that. And I also think, proxy voting is starting to become, a thing that people talk about. When you are investing in a company, in a stock, like you are you are an owner of it, and understanding what that means. And if you can join together and, express what you want as an owner, like I think that's extremely powerful.
I want to ask for, I talked about how in your role, you get to see what investors are doing and how that implies things. Every time the market takes some sort of significant downturn, what you hear the talking heads say on the media is, this is no time to panic, which I laugh about because that implies that there is a good time to panic. I've never found one, but maybe there is. But I'm curious because we talked about buying opportunities. So the next time that the market gets really hairy, whatever it is that's going to drive it, I'll leave that to the imagination. What will be the sign to you that the audience, that your clientele is not reacting to this like this is another dip, but that they are doing something? Like, what will be that difference of, the market gets hammered, people are unhappy? What will be the one where you go, no, this is not regular unhappy?
I usually watch, there was a moment earlier this year that I did see that. And I saw a switch starting to happen. And I actually, no, it wasn't last year. I was thinking about how we had, every 1 to 2 years, like Peter Lynch says, you should have a correction, and that's healthy. And if, so I remember the last real correction we had, despite, Liberation Day, but like market correction was July of 2024, I think, or beginning of August. But there was a moment in February. It was before Liberation Day happened and took the markets down. There was a moment where I started noticing like the markets were getting a little soft, but it wasn't meaningful yet. And I noticed that the activity wasn't just buying more. In fact, it was one of the first time I'd seen like a net sell day. And I thought, something's switching underneath. And they were, if you look at that time period, like if you're actively trading, right? Not if you're a long-term investor thinking about the next 10 years, but if you're actively trading, that was a moment I thought something's switching and they're holding back. They're waiting for something more. And so I don't know if that's always going to be like a great sign for me every single year, every single moment. But the general trend was that they were waiting for a later opportunity and not in that moment to buy the dip. And that, if you look at like the trajectory of the market, that was the right thing to do. I don't know if they'll get it right every time.
And nobody gets it right every time, certainly not the masses. We talked a little bit, I want to bring it back to market conditions, et cetera. You were talking about valuations. What do you see happening with valuations in terms of international stocks? And are you seeing more interest there? Or are you more interested there because of the valuations? Or do you think that the benefit we've seen for international this year was mostly a currency play, in which case valuations matter less and the currency play may be over?
I think it was largely currency for European stock investing. There was obviously a connection with increased stimulus from, Germany being able to like lifting their ability to take on debt to spend, especially noticing after some of the NATO meetings and things like that, there was, a commitment to spending more on defense, and that tends to lift all boats. But I do think it was like half of the return came from currency, and it hasn't been as strong a return since that sort of movement has cooled off. So for Europe, we were much more positive earlier in the year. After Liberation Day, I also really liked Japan, but on a currency hedge basis, because I thought they would be incentivized to have a trade deal. There's obviously a bunch of political changes that were happening there. We still have some positions in our Robinhood strategies portfolios, but the Chinese tech industry is a place that I've been positive since the beginning of the year. Actually, I remember since I'd say sort of September of 2024, there was a bump and then it dropped a lot. But really since then, like that's a place I felt has been undervalued, continues to be undervalued, although a little less because it's up quite a bit this year. But I think if there's one place that one is incentivized to continue to be self-reliant and two can give the US tech industry a run for its money, it's that. We definitely, have clients that have not been super happy about, like they're just politically didn't like having those investments, but we're here to invest in what we think will do best. So that's a place that it's a little less cheap, but it's still pretty attractive to me.
I have more questions. I just don't have more time, but this has been great. I very much appreciate you joining me on the show, and I hope you'll come back and do this with me again sometime.
Absolutely. Thank you for having me.
That's Steph Guild, Chief Investment Officer at Robinhood. Go to Robinhood.com for more information on the firm. Up next on Money Life, it's market call time. Mike Dixon from Horizon Investments will be here. He's going to bring his quantitative approach to stocks to the show right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Mike Dixon, Head of Research and Quantitative Strategies at Horizon Investments, is here. We're talking stocks. It's time for the market call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And putting it all together and how they do their job, really important today because my guest is making his debut in the market call. Mike Dixon is Head of Research and Quantitative Strategies at Horizon Investments. You can learn more by knowing the name of the firm and going to horizoninvestments.com. But you hear in the title, Quantitative Strategies. And you know, if you listen to this show, we kind of love talking about those strategies where you're mixing a little bit of art with science, you're doing all those sorts of things and bringing it in. So the methodology, really important. And he's got a methodology that I think you're going to like. So let's jump into it. Mike Dixon, welcome to Money Life.
Thanks for having me. Appreciate you being here.
We always start with methodology. And like I said, quantitative strategies tell us that the methodology here is going to be based on something where you kind of have a formula. We need to understand how it works.
Well, I'll be happy to dive into that. I think, as you mentioned, with this quantitative methodology, I'm very data-driven and like to kind of score investments across multiple criteria. I think it is important to look for balance across not just price-based signals of trend and reversion, but also looking at fundamental factors like earnings, valuations, profitability, and those sorts of metrics. And then, separate from all of that, making sure we clearly define the investment universe that we're kind of applying that methodology to. And I like to think of that, in kind of two approaches. One, kind of a longer term like allocation framework where we're looking to make decisions across, broad, allocation levers such as U.S. versus international stocks, broad styles like value growth or small caps versus large caps, sectors as well. And then separate from that, taking it a little bit deeper with a stock selection methodology where we get a little bit more precise in exactly what those price-based and fundamental factors are, but we're scoring the stocks at that point relative to their industry peers. And those are really kind of the two different levels that we like to make decisions on and kind of score our investments. And we have views kind of along, both of those dimensions.
I love talking to quants because you're talking to a quant when you say, like, what's your favorite stock? And they answer, I don't have one, but the system tells me I like this. And we talked to a fair number of quants here. And one of the things we found is that with each quantitative system, there is some decision that has to be made about how much of this is going to be the art and how much is going to be the science. So since you talk about scores, for example, on stocks, how much is art versus science? How much of it is no. If it doesn't score high enough, we don't come up with a reason to buy it. Or if it scores low, we don't a reason to hang on to something if the score has changed. Is it 100% we're relying on what the system tells us? Or is it we get the system and then we add to it?
Yeah, I think in the world of finance, right, this is not the law of physics, right? So the rules and the correlations and these things are not always stable. So I think in any decision, there is going to be a discretionary component where you do have to take into account whether or not, very new information is completely captured in a lot of your metrics. But look, I would say there's a significant amount of art in the development of the system to begin with. And I'll also say it's not a static system. We are constantly get new information in the markets. We constantly have, changing broad macro regimes that may make some factors more or less important. So any good quantitative system, I think, has to have a significant amount of art in the sense that, a human is doing a lot of research, determining what the appropriate metrics are to include in the system, trying to ascertain whether or not recent market data, fully accounts for, ultimately what type of signal you're trying to get from a particular data point or a group of data points. So, even though it is a linear system with step 1 through N, there's a significant amount of art and constant research that goes into kind of defining each of those steps and making sure that it's truly capturing, exactly, what kind of signal we're trying to eke out from the particular set of data points that we're looking at.
Okay, so let's talk about some of the data points that you're getting right now from the market and what kinds of decisions and things you're looking at, because into this market, you have to make decisions about what sectors you want to be in, what markets you want to be in, what styles you want to be in. What are you finding now and what's going into the asset allocation models?
Yeah, sure. I mean, so starting overall with the kind of longer term strategic allocations, there's a framework we use here. We call it the GRID framework, which stands for growth, risk, income, and discretionary decisions. And so on the growth side, this is where we're looking at things like expected earnings, revenue growth, changes in margins, the direction of travel of these particular trends. On the risk side, we're looking for things like changes in valuations over the similar horizons with those similar metrics. And then on the income side, this is going to be dividend yields, buybacks, changes in these variables, and discretionary is going to account for things like central bank policies, fiscal policies, and other, sort of hard to pin down components and their expected impacts on these key decision points. And so, taking that, in its totality, looking at today, just along some of the bigger dimensions on a regional basis, one thing that I like a lot is global allocations versus just the U.S. only. Now, the U.S. has been obviously a significant source of growth. I'm not saying that we shouldn't be market weight U.S. in a global portfolio, but international stocks have had a fantastic year with a majority of the return coming from the earnings side of things and the revenue side of things. And so, international markets broadly tend to trade at a lower multiple than U.S. counterparts. A lot of that has to do with just in general what the sector makeup of those markets look like, being more heavily exposed to industrials, energy, utility, materials types of companies that are a little more cyclically oriented. And of course, the U.S. is very much dominated by, very high profit margin oriented tech firms. And so, given that, we expect the international block as a whole to trade at lower multiples, and it does so. But what we've seen this year is a pretty significant uptick in the earnings and revenue growth and what that attribution has looked like into the total return and the trends of the international block. And I think that given that their valuations have not moved up in kind, it really makes the international block overall look a good bit more attractive. And in particular, given that sector composition is a good bit different than the tech-heavy, nature of the U.S. markets, you get a good bit of diversification there by including, the international block in both developed and emerging markets alongside, U.S. Centric portfolio. And so, at a high level, this regional allocations, I think global allocations are poised really well to take advantage of a lot of the diversification benefits, but still giving you exposure to pretty good momentum on both top and bottom line that we've seen this year so far.
Do you have preferences on cap sizes, things along those lines?
When it comes to kind of going a little bit deeper on the style side, whether it be on the cap size, again, kind of starting place, I continue to like the large cap U.S. growth because that has been the main driver of the market. We've actually seen both revenue growth and earnings growth really inflecting higher in the top of the market on the U.S. side of things, but you have not seen valuations move up in kind. So, large cap U.S. growth, I think a necessary core exposure. On the other side of that, though, you have a bunch of other large cap companies that are not necessarily just the top end of the spear as it relates to the AI trade, but you then have smaller cap stocks in the U.S., right? So smaller cap stocks have not participated in nearly the run-up that we've seen this year with the top of the market. In fact, you take something like the S&P 600, you're only up 4 or 5% for the year. But one of the things that I think is great about the smaller cap area of the market is there are multiple catalysts that make that trade, I think, poised to actually participate in this kind of broadening out theme that we hope to get. And some of those reasons are, one, with the Federal Reserve and interest rates overall, higher rates are pretty much completely off the table. Whether we get a cut in December, that's going to be determined by this reopening of the U.S. government, what all that data says, but the direction of travel and rates is down, and small caps have struggled to really weather the higher rate environment. So that's going to be a good shorter term catalyst for that trade. A little bit more in the medium term with the smaller caps. We just got out of earnings season for the most part, where the smaller cap companies are, over 80, 90% of the way through earnings season. And we saw earnings growth this quarter of about 12% for smaller cap stocks. That's right in line with the large cap universe. And this is a pretty good step size higher, both this quarter and last quarter, than we've seen in the previous 18 months or so for smaller cap stocks. So you're starting to see a pretty strong kind of broadening out in earnings and get a lot of that participation from the smaller cap names. And then most importantly, you've had valuations actually down about 5 or 6% year to date within that kind of S&P 600 type market. And so that makes for a very attractive setup given those two catalysts. And then looking a little bit longer term, the smaller cap areas of the U.S. market have been very under-owned for a while. And there's additional tailwinds like M&A, domestic focused policies, and just overall easing regulations that are going to be very conducive to these smaller cap names. And they're poised with lower valuations and that lack of significant rally to the top side that we've seen for the large cap growth area of the market. I think that's poised to be a really interesting trade for a longer term hold as we head into 26.
Is there a name or two that are poster childs for the methodology, the kind of thing you particularly like right now?
Yes. Yeah. One of them that I'll throw out in kind of the mid cap space, Tenet Healthcare. That's a name I really like in that kind of smaller mid cap healthcare, which I think is an area that is really poised to participate as kind of a contrarian play in the sector space. So that's one area and one name that I'll throw out that I really like in the mid cap space of the market.
Something else that stands out to you right now?
A couple of things that I'll throw out. One on the kind of large cap growth area. One of my favorite stocks there is going to be Google. This is one of the fastest growing large cap growth companies in the market. Believe it or not, if you look at valuations for the comm services sector of which Google is a part of, and you look at Google specifically, you're talking about whether it's based on earnings or revenue, valuations are roughly in line with the market, but profitability and margins are just off the chart. And you've seen significant growth there on the Google side. And one of the things that I love about Google as well, it's kind of been caught in the crosshairs of, is it going to be hurt by the AI trade, or is it going to be the tip of the spear of the AI trade? And I think that kind of battle back and forth has kept valuations kind of relatively range bound. And I think they are showing success at really being at the tip of the spear. So that's one of the fastest kind of growth companies that I really like right now, kind of in that large cap growth side of the market. And then, another name, I'll throw out, a little bit on the more contrarian side of things is going to be Eli Lilly. So this is a healthcare juggernaut, one of the largest players in the healthcare space. The healthcare sector overall is really one of my favorite kind of contrarian plays right now. And Eli Lilly is going to be poised to be one of the biggest benefactors, I believe, of that contrarian theme if that plays out. And I think it's just got a very, very attractive profile as it relates to its earnings and revenue growth, profitability metrics, a strong recent momentum. And I think one of the more important things, Chuck, that I'm looking at in this kind of single stock methodology is looking across a number of different metrics. So I'm not just looking for low PEs or just high revenue growth. You're looking across the balance sheet, looking across the cash flow statement. You're looking at things like the level of volatility and risk-adjusted trend over various different horizons, looking at things like short interest and changes there that can give you a good read on sentiment. And Eli Lilly is one of the top scoring securities kind of in that healthcare sector, and one I really like for a little bit more contrarian play to offset that large cap growth and kind of, Google pick in particular.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Shall we play a game?
Well, I don't know that I would call it a game, but when you're talking about quantitative investments, that's kind of always what I picture the system talking back to us. And today we are talking with Mike Dixon. He is head of research and quantitative strategies at Horizon Investments. Maybe he doesn't envision his own system sounding like that, but if you want to find out what they do and learn more, horizoninvestments.com. You know how quick and dirty works. We're a little bit late getting here, so we will jump in right away and start with a request from Dale in London, Ohio. He shares it with Bill in New Orleans. Both want to know about Kimberly-Clark Corporation. That's ticker KMB.
One of the things, Chuck, about my system here, got a number between 1 and 100 that'll aggregate across 30 different characteristics and stock fundamentals to give me a read on how attractive these stocks are. For Kimberly-Clark, I'm going to give that a sell. Only scored a 19 out of 100 in my systems. One of the things that's kind of dragging that down, being in the consumer staples sector to begin with, and the defensive take there, not great. It's had pretty poor momentum lately, poor overall earnings and revenue growth, some recent volatility, pretty big kind of recent drawdown, and virtually no beta to the market. So not loving that stock right now.
Something smells like rancid rodeo around here.
Rancid Rodeo, 19 out of 100. Yeah, pretty much. KMB, Kimberly-Clark, that's a seller and a void. You mentioned healthcare, et cetera. We're going to talk a little bit about some related fields. Laura in San Antonio wants to know about Abbott Labs. It's ticker ABT.
Yeah, I really like this one. I mean, with my comments on healthcare sector overall, this is an area of the market that is screaming a very good value buy. Abbott in particular, scoring 85 out of 100 on my system within the S&P. It's got middle of the road growth, strong kind of value scores, very good risk metrics, and a strong diversification kind of score within my system. And then just healthcare overall, I think is really poised to be a good contrarian play because over the last 1 to 3 years, it's one of the worst performers on a broad GIC sector basis in the S&P, but you've seen significant top line revenue growth here, only behind tech in Q3. And so given the attractive valuations there and the high top line growth, I really like the sector, and I like Abbott in particular, scoring quite well in that particular sector.
Buy it outright.
That's buy on ABT, Abbott Labs. Tom in Smithfield, Kentucky wants to know about Quest Diagnostics, DGX.
This is one of my favorites. I got a 98 out of 100 here, okay? You've got a significantly above average growth, very attractive valuations. Most importantly, it's in the healthcare equipment subsector of healthcare, which I think is poised to be potentially a big benefactor from, AI and robotics and that sort of thing. So with the full quantitative system, 98 out of 100, a little discretionary overlay, healthcare equipment, I'm really liking that. So a strong buy on that name.
Winner, winner, chicken dinner.
Yep, that's a buy on DGX, Quest Diagnostics. Getting out of healthcare, Sam in Woodbridge, Virginia wants to know about American Tower. That's AMT.
Overall, kind of real estate sector, not really liking that very much. I'm going to give this a 30 out of 100, so definitely not buying that. Low growth, not great valuation metrics to reflect the lower growth. Kind of only thing going good for this stock, I think right now is going to be the overall kind of dividend yield you're getting, but it's got a pretty low beta to the market. It doesn't score very high on my multi-factor process, so not loving that one, Chuck.
Sell immediately. Entire portfolio at market, regardless of cost.
Not loving it, maybe selling it on AMT, American Tower Corp. And last, for Sean in Grinnell, Iowa, it's Berkshire Hathaway. It's BRK.B. Nobody ever says anything bad about Berkshire Hathaway, do they?
Well, you're not going to hear that from me today. I've got an 85 out of 100. Obviously, great diversification, solid value score, lower risk side of things. One of the things I'll point to that I like about it right now is it's really yet to rally, but it's kind of been fluxed up a little bit recently. So I think with the solid kind of fundamental background that you've got there and how that score ranks and the fact that you actually haven't seen it rally yet, I think a good time to get in there if you're not already an owner. And if you are, certainly a hold.
That's why we should buy now.
A lot of people have been saying maybe not to buy now on Berkshire Hathaway because, of course, Warren is retiring. But that was a buy on BRK.B, Berkshire Hathaway. And speaking of good buys, time for us to say ours to Mike Dixon. But, Mike, really appreciate you joining me on the show. Glad we could do it. Let's do it again sometime.
Absolutely. Thanks for having me, and appreciate it to all your listeners as well.
That's Mike Dixon, the head of research and quantitative strategies at Horizon Investments. Go to horizoninvestments.com for more information. We'll come back. We'll let you know if Mike agreed or disagreed with some recent guests on a couple of those picks, and then we will cross the finish line together. This is Money Life.
Hey Money Lifers, it's Rob Floyd, the show's executive producer and normally the contest master. This week, however, Chuck has come up with his own contest for 3 interesting books he discussed on the show. Those books are My Mother's Money, A Guide to Financial Caregiving by Beth Pinsker, who was on the November 4th show. The Perceptive Investor, The Art, Science, and Temperament of Successful Value Investing by Arda Low-Groniger from November 5th. And Soldier of Fortune, Warren Buffett, Sun Tzu, and the Ancient Art of Risk-Taking by Tobias Carlyle, who appeared on the November 6th show. To win the books, you have to tell us Warren Buffett's 3 largest holdings in Berkshire Hathaway. Give them to us in order, please, as the name of his largest holding gets you entered to win My Mother's Money. His second largest holding gets you an entry for The Prospective Investor, and the third gets you a shot at Soldier of Fortune. Send your entries along with your name and address to chuck@moneylifeshow.com by 7 p.m. Eastern Time on Thursday, November 13th to enter. And please put the word contest in the subject line of your email. Chuck will announce the winners on the Friday, November 14th show. Good luck, everyone.
We're back to put a bow on this show. Thank you for sticking around all the way till the end. Hopefully this will be worth it for you because we do have some crossover. So let's jump in and get that done. Mike Dixon talked about Google early on. He talked about Tenet Healthcare, which we haven't had crossover with, but then he mentioned Google. John Dorfman from Dorfman Value Investments was buying it on September the 16th, but Cole Smead from Smead Value was selling it on August the 21st. And that, by the way, is why you want to always have a guy define what value is, because they're on the opposite sides, even though they're both value managers. It was the poster child for Dave Sekera from Morningstar back on August the 8th. Richard Howe from Stock Spinoff Investing was buying it on June the 24th. Then during Quick and Dirty, you had American Tower as a sell. It was a sell yesterday from Peter Krull from Earth Equity Advisors. And yes, they both picked it off the list. They got the list last Friday. It's the same list to both of them. There's like 500 names on there. And yet they both picked American Tower and they both were selling. Then you had Berkshire Hathaway B. It was a buy today. It was the poster child for Mark Travis from Intrepid Capital earlier this week, just 2 days ago. So you had agreement on a sell for American Tower this week, and you had agreement on Berkshire Hathaway. It's a buy. Stephen Gray from Gray Value Management had it as his poster child about a month ago, October the 17th. John Dorfman also liked this one, so that's a buy from September the 16th. And Ed Schill from the Wealth Enhancement Group and the QCI team was buying it back on June the 23rd. So there is your crossover. Tomorrow we'll cross over with more great stuff because we'll have Todd Rosenbluth here. Robert Farrington from The College Investor did some work on how good AI is when it comes to giving out financial advice. We'll talk with him and go off the news there. We've got a survey to talk about and more. So tomorrow will be another great show. I hope you will join us for that. Meanwhile, if you're looking for something to celebrate today, well, almost everything today is about food, but it is Fancy Rat and Mouse Day, and I wouldn't call Fancy Rats and mice feed unless you are some sort of a critter that eats those things. And besides, they're the fancy ones, so maybe they're not meant for that. It's also Chicken Soup for the Soul Day, which is not so much about chicken soup. It's more about the soul, but still somewhat food related. It's National French Dip Day. Come on. Who does not like a good French dip? And it's Pizza with the Works except Anchovies Day, which I love any day that celebrates pizza.
Pizza.
But let's face this one. Pizza with the works except anchovies. A, that's not the works if you technically have the works. B, nobody really wants anchovies, but the only way it makes sense to have pizza with the works except Anchovies Day is to also have a pizza with the works including Anchovies Day. I don't think there is one of those. And to wash it all down, well, it's Happy Hour Day.
My advice to you is to start drinking heavily.
At least for that 1 hour, perhaps. My guests today were Chip Lupo, writer and analyst at Wallet Hub, wallethub.com. The link to the household debt survey in our show notes. Stephanie Guild, chief investment officer at Robinhood, robinhood.com. And Mike Dixon, head of research and quantitative strategies at horizoninvestments.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Peter Lynch, who said, when looking at the same sky, people in mature industries see clouds where people in immature industries see pie. Yeah, a particularly good lesson to remember when we look at what's happening with AI, but you always want to keep perspective, which is why I tell you every day, Until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Have a nice life. What's left of it?